Hello again, traders. Dwayne Chabot from DRFX, Forex Swing Trading. Going to be taking a look at the recent accurate forecast that was done on the US Japanese yen, where I predicted that the market was going to continue a sharp rally and break out above the resistance boundary of the pennant setup on the daily chart, and speak to how I took advantage of it and how other traders can take advantage of these types of forecasts based on their individual trading strategy. Now here you can see this tweet that I had sent out on September 15th, where I had basically shown that the market had this setup on the daily chart of the US Japanese yen in the form of a pennant, and that based on the setup and based on the signal that was given at the support boundary, the market had a very high chance of rallying to resistance and then breaking out above resistance to continue a sharp breakout in favor of the US currency. So this was, as you can see here, this is the theory behind consolidation setups and false breakout reversals, where the market will give a signal indicating an attempt to start a movement in one direction and follow this up by a sharp and aggressive movement in the opposite direction that takes us back initially inside of the consolidation and then break out at the other end of the setup. So the setup on the US Japanese yen was exactly as you see here in this textbook example, and this was therefore the justification as to why I predicted that the market was gonna continue this bullish movement in favor of the US dollar and provide us with trading opportunities as part of this movement. Now, taking a closer look at the theory behind these false consolidation breakout reversals, these are sometimes the traps that many traders fall into, where the market will give us a signal at one end indicating that the market is going to be starting a breakout. But if the signal that is given here is too weak, then the market has a very low chance of moving in that direction, and that there's a much higher chance that the market will reverse and head back inside of the consolidation. There are times when the market will continue to move within consolidation after reversing, but in many cases, once the signal given to start the reversal is strong, more than likely the market will continue this reversal and break out at the other end of the consolidation and continue this reversal. So this was the theory behind the forecast for the US Japanese yen. And as you can see here, this breakout and this sharp rally to continue the bullish movement took place exactly as forecasted. So the market continued the reversal in response to this bullish signal, following the weak attempt to break out short below the support boundary, rallied and took us initially towards the resistance boundary here, pulled back and created a little bit of volatility here, but eventually the momentum was strong enough to outweigh the selling pressure at this area here and continue the rally and continue to provide significant gains in favor of the US dollar. Now, there are many ways in which you can take advantage of it by trading these movements. One of which was to, in my case, trade between this area here and the resistance boundary, exiting at an area just below the resistance boundary here in anticipation of a temporary pullback, even though it was likely that the market was going to continue to move higher. Now, this was part of my previous trading strategy, where I would hold the trade for much longer and take advantage of these movements. But what I found is that we can take advantage of shorter movements and capture shorter trading gains in terms of pips, but larger returns per trade by using a wider risk to reward ratio. So even though you can predict where the market is going to be headed over the next 5 to 7 days, if you can take advantage of smaller movements as part of that larger movement and capture a strong rate of return within a very short period of time, then it's a much better choice than waiting several days, given the uncertainty that we know is associated with the currency market in general. So as you know, I took my signals based on the FXCM trading patterns, but my live trading is actually done on my FX Pro account. Shown here on this screenshot of my live account, where I took advantage of this rally on the US Japanese yen with a fairly ordinary trade, taking advantage of the bullish engulfing candlestick formation on the 4-hour chart. So this was a short trade, but it provided a rate of return of 3% overnight, which I believe is a very strong rate of return on a trade in the currency market, compared to wanting to hold trades for 5 to 7 days within the context of possible volatility that can work against you. Nevertheless, once you're able to predict these movements that are taking place across the currency market over the next 5 to 7 days, you can trade them based on the particular trading strategy that you're comfortable with, whether long term, holding up for 5 to 7 days, or short term, which is more aggressive, where you can capture fairly significant rate of returns in a much shorter period of time. So once you know the theory of the currency market, you can take advantage of it, whether it comes to false breakout reversals, head and shoulders patterns, or other types of candlestick patterns that are very common across the currency market. Once you know the theory behind what is taking place across the currency market, then you can make accurate predictions and make accurate trading decisions that can provide you with strong rates of return in a very short period of time. So until next time, traders, happy trading.